Good day. This is me, Van, here from Iconic Mortgages with our special guest, Alex from Ourboro.
You said Ourboro correctly. You nailed it.
Perfect. Thank you. You get different names for Ourboro, right?
We will often we get like Ourboro, people. Yeah.
I'm a bit familiar with you guys, so that's good.
Yeah.
Thank you for taking time, especially in the festive season. I know it's it's a December, so thank you for having me. So let's talk about your company. Like, you want to walk us through how it's started and where you guys see the need for it. You guys are filling the biggest gap in the industry, and especially making a lot of individuals' dream come true. So you want to talk a little bit about yourself, about the company, how it started. We'd like to hear from you.
That's a lot to cover to jump off. Sure, happy to start chipping away at that. So Ourboro is a shared equity investment fund. So at the end of the day, we manage capital on behalf of investors, and we pool that capital and we deploy it into down payment contributions alongside home buyers. So currently, we're the only ones in Canada doing this exact model, using down payment as a way to help people get into the home ownership. We know that saving for a down payment is a significant gap that's keeping a lot of people out of home ownership. So what we do, what shared equity means to Ourboro, is by contributing towards a down payment, we essentially get a right to the future profits of the home. So if we contribute half of the down payment with the homeowner, then Ourboro gets half of the appreciation in the home later down the road. So it's quite simple, quite elegant, and we think that it's quite easy to understand, but because it's novel, it still takes a while for people to wrap their heads around the concept that we're not debt. We contribute up to $250,000 towards a down payment. And that's not an amount that they are paying us back over time. Ourboro only gets paid, down the road, whether it's 5 years, 7 years, 10 years down the road when the home sells, or when homeowner, buys out our share. So that's Ourboro in a nutshell. What would you like me to cover next?
So where do you see the niche for this? It's the first company in Canada who's offering this. I think maybe it's one of the only company I know is Ourboro who does it. Where do you guys? What made you guys to get into the business, and where do you guys how do you guys get into the business, and talk about your founders and what's your vision is and what's your value for the company?
For sure.
Because everyone needs to need to know who these guys are.
Yeah, and kind of the why, right?
Why?
Yeah, first we have to acknowledge Ourboro, we're not the first ones to have this concept. The idea of shared equity has been done in the US quite successfully, in the UK. And also even here in Canada, there are nonprofit models that does co-ownership.
Is it similar to rent to own?
No, rent to own is different, but rent to own is another comparable program that's out there to help people just creative ways get into the housing market. With credit to sort of the predecessors or the different similar models that are out there, that's what inspired Ourboro. So Ourboro was founded in 2019.
5 years.
Yeah. Actually, almost 6 years now.
6 years now,
Yeah. And so the co-founders of the company, Nick Pope and Norm, I've met them. Like Norm specifically, I've worked with at that time already worked with about a dozen years. When Norm approached me with the idea, and he was trying to build a team and trying to operationalize the idea. And so the genesis of Ourboro was really inspired by the idea that residential real estate has been one of the most lucrative forms of generational wealth creation, right? If you look at the past 50 years, even in Toronto, in any 10-year period, the average appreciation of a home has been at least 7%. Even in the dips, it's just been stable. But what's happening is this bifurcation of the market. The people who have access to generational wealth, we've seen the statistics. People who have parents that own homes are twice as more likely to own a home themselves than people who don't have parents who own homes, right? So there's a splitting. And I know for Norm and myself, my background has been in impact. I started off in Bay Street and then went into the nonprofit space, and really been dedicated my career for the last 15, 20 years at this intersection of business and impact. So Norm, one of the co-founders, and I had worked very closely in that field. How do we take profit-seeking capital to invent creative solutions and use profit-seeking capital to create positive social impact? In fact, him and I had taught together many years at the University of Toronto, and I still do to this day, on social entrepreneurship, which is that idea. And so Ourboro really is a manifestation of that. That's the why. We want to create a win-win option. So investors are getting a leveraged return on their investment. They're accessing the residential real estate. And at the same time, instead of being landlords, right, their investment is actually helping people own the places that they live in.
Got it. So how do you compare your program to CMHC shared equity program?
Great question. So the CMHC Shared Equity Program was actually recently wrapped up in the spring of this year. It functioned for a number of years. It was called the First Time Home Buyers Incentive Program. And, it was well-intentioned in the type of problem it was trying to solve, which is bridging the down payment gap. But we found that a lot of the restrictions of the program, or the requirements, I should say, were quite restrictive.
Okay.
There was an income cap. So I can, for your listeners who don't know, the CMHC program provided essentially a government loan to help bridge the down payment gap, to help people buy their first home. So it was
and
only
also
for
limits
first-time
the
homebuyers.
purchase price as well with the
Yes,
$1 million
yeah.
purchase.
So it was a similar idea. They contribute towards a down payment, except their down payment contribution was structured more or less like a loan, in the sense that when your home is sold, you do still need to pay back the government. Even if your home decreases in value, there's still a minimum amount that the government needs to be repaid. But the real challenge with the CMHC program was the requirements. There were income restrictions, there were purchase price restrictions, and there just wasn't a good fit between where people felt the need for that versus, people who could actually access it.
As a mortgage broker, I can speak behalf of it. It's a great program, not in GTA.
Exactly, not in urban markets.
Yeah, not in Vancouver, not in Toronto. It's not the best program, but it's definitely serve the clients outside the GTA or smaller markets.
Yeah, exactly. And I will say, they, as part of the CMHC program, they also had they had funds in what was called the Shared Equity Mortgage Program, so that they were able to take the capital that CMHC wasn't able to deploy themselves. And the CMHC actually invested $5 million into Ourboro's fund, into that investment pool I talked about. And Ourboro has we deployed those funds in about 8 months. It's through our program. So we were able to do it much more efficiently because our program had broader requirements. Yeah.
So who's your typical end users of the program? Is it new to Canada? Because as a mortgage broker, I run into a lot of new immigrants.
Yeah.
They have a great income,
but
it's not a generational wealth. It's not here. So they're limited with a down payment. So is it the niche market for you folks?
Very good question, because it goes back to kind of the underlying mission of Ourboro, which is to help people who face barriers to home ownership. So we've recently done some studies to understand our demographic, and we've actually launched a 10-year longitudinal study with Conestoga College to measure our program. But to answer your question around the target audience, we found that close to 50% of our homeowners, like people who do end up using our product, were born outside of Canada. Yeah. And that really supports our thesis that these are families who don't have parents who own real estate in Canada, right?
So no generational wealth.
Exactly, no generational wealth.
Or no bank of mom and dad.
You got it. 30% of Canadians have bought homes last year with the bank of mom and dad.
Absolutely. I see that all the time.
Exactly. And I think what was the latest, the average contributions over $200,000 now from the bank of mom and dad.
Yeah.
A lot of our homeowners are newcomers, or definitely first-time home buyers, young families who have been living in an urban area, maybe in a condo. They need more space. They can't afford to buy the detached home in the urban area. So either they're forced to move out of the city, or a program like Ourboro can help them stay
in the city,
in their communities. Yeah.
So the other thing I want to ask you is, how are you differentiate? Because when you talk about your program, it's very similar to rent to own.
Sure.
That's the first thing that came to my mind.
Yeah. So we can speak to that.
So maybe we want to kind of give some clarity on how are you folks different from rent to own?
Yeah, perfect.
Because a lot of audience may probably think,
I know, and thank you for giving me the opportunity to demystify our product by comparison. So rent to own programs, as you would know, are often structured for people who are trying to build credit, right? Or who just need almost more of a forced savings program. To be able to build up their down payment, so that at the end of their rental term, there's a little bit of equity that could go towards a down payment. And there's also the benefit of sometimes some rent-to-own programs, contracts have a fixed purchase price that's been locked in a few years ago. So the key distinction between Ourboro and rent-to-own is that Ourboro homeowners are owners on day one.
From the day one.
From day one. They're not renting. Rent to own is the reverse, right?
Reverse. You don't own until the transaction is happening.
You're renting until you can buy the home. Yeah. So with Ourboro, our buyers, they're owners on day one. they have a significant equity share on day one, anywhere from 25 to 75% of equity. Whereas with renters, they're only building up equity marginally over
it takes
time.
a very long time.
Yes, exactly. So I would say our product is quite different because you're in the home, you own it on day one, you have significant equity interest, and the risk and rewards balance is pari passu, is equal.
Equal, yeah.
Yeah.
Walk me through, how did you guys dealing with challenge from, so you started the company in 2019,
right?
And you probably start the program in 2021, 2022.
Yeah, the whole startup journey. We've been there.
The market was high up here.
2022, yeah.
And I'm sure you probably did some lending or program and assisting the first-time home buyers. Now the market is down.
Yeah, so you know what? Like it's really interesting because...
So how are you kind of managing the expectation with the borrowers and...
With our clients, with
your
our
clients,
homeowners?
and also your investors as well?
Yeah, so I mean, for our investors, our ramp up, I mean, we actually just recently were looking at the data of this. We launched like publicly, like the company was created in 2019, but we were doing some pilot programs and like limited release, but it was really available to the public in the spring of 2022. So that's when market was really picking up.
Okay, so you guys got into the right time in the market.
Yeah, so the market was just starting to pick up, and it definitely hit the peak probably in like 2023.
Yeah.
But we were also just ramping up. Yes, we launched, but the majority of our capital deployments has actually been in the past 18 months.
Okay.
So if anything, as markets have been coming down, and if as
market's
an investor,
going up and buy words,
as an investor, you would know that the best time to buy
is when the market is
actually
down.
When the market is down. So it's actually worked out quite well for our portfolio. The bulk of our deployments has been on like more of the trough of the market. But from like the startup journey perspective, like challenges, we've been through it all as a startup. But when the company was first created, we were from startup capital, we kind of have double-ended challenges on the financing side. We're constantly raising investment capital for our fund, like always. That's always going to be a perpetual thing for deployment into down payment investments. And then there's our corporation, just our entity, our marketing, our staff, like the operational costs. And for that, Ourboro hit a critical inflection point in 2021 where we partnered with Peerage. We became part of the Peerage Realty Partners portfolio company. So Peerage Realty owns the largest conglomerate of Sotheby's real estate brokerages across North America. They're also the parent company of Chestnut Park and own a number of other institutions and asset management firms. So, Peerage is now a majority shareholder of Ourboro, and they've been sort of our private equity partner since 2021.
Nice.
And has been like absolutely instrumental in our success since then and our trajectory.
What are the qualifying criteria you folks have for the borrowers? I know the banks has their own criteria. So I work with a couple of lenders who work with Ourboro. So they have their own criteria. They don't care where the down payment, I wouldn't say they wouldn't care. They really look at the down payment is 20%.
Yeah.
But they don't look at what the source of down payment and all those things. They just want to make sure the down payment is coming from you folks. What is your qualifying criteria? What do you guys look in terms of the borrowers to grant the down payment?
Yeah. So Ourboro, as an asset investment, like as an investment fund, we say our focus is on the underlying asset, which is the property.
So that's your biggest C.
That is our due diligence. That is where we focus. A lot of our review and criteria is actually underwriting and evaluating the properties. Buyers, we do have criteria. There are income restrictions. Your listeners can visit our website, but essentially, there aren't income restrictions. They're property price restrictions.
Yeah.
Minimum 550, maximum 2.5 million. They need to have enough income to qualify for a mortgage at 80% LTV. And they need to have a minimum of 5% saved. So we do have some eligibility
So they have
criteria.
some kind of skin in the game.
Yes, they have to. Yeah. But otherwise, we rely heavily on our mortgage broker partners and the lenders. So basically, our philosophy is that if this homeowner qualifies for a mortgage and they check all the boxes on the mortgage underwriting side, that they qualify as a vetted borrower, then they can qualify to work with Ourboro. We make sure that you're buying a good property because that's where we de-risk our investment, is that this property has good upside potential.
So is there any changes you folks will be making based on what's happening with the CMHC? So I do understand
the latest CMHC.
The latest
update,
CMHC,
yes.
It could be a challenge for your business.
Yeah.
Being completely transparent, that's what first thing went through my head because a lot of individuals, they want the down payment about $1 million purchase price.
Yeah.
Now that's been scale up to 1.5 with a 30 amortization. So you feel like your market is going to be segregated into a alternate lending versus CMHC or like a institutional lenders?
Well, I mean, first of all, we never position ourselves as lenders because our contribution is always an investment.
So I mean, maybe as your end users.
Yeah, exactly. But that said, though, as soon as the announcement came out from CMHC that these changes were anticipated, we looked at our data and we looked at like how are people actually using our program. I mean, we're always tracking that, but we wanted to understand how would these rule changes impact our product. And it was actually quite interesting to see that the vast majority of homeowners who are using us are actually purchasing below $1 million.
Below $1 million.
Below $1 million.
So first-time home buyers.
First-time home buyers.
They just want to get into the market.
Yeah. So when we introduced Ourboro, our hypothesis was that, if you're buying a home over $1 million, you need 20%. You need a minimum of $200,000 saved. Who has that, right? So we thought the biggest pain point would be for people buying above $1 million. And we still do. A large cohort of our buyers are still above $1 million. But especially in the last 18 months, a vast majority are purchasing below. And I think that's a reflection of the higher interest rate environment, right? So they need the down payment to actually bridge the gap between what they qualify for in mortgage and the property that they're looking for. Now, above $1 million, we also looked at, even with the CMHC rules change, if you're buying a property over $1 million, you still need around like 125. I think even at the highest,
minimum 125,000.
Yeah, at like that 1.5 range, which is still a lot. The average savings amount for our homeowners is close to like 60 or 70K. So they still might not have enough saved to buy on their own, even with the CMHC rule changes. But our position is always that like any policy changes that helps buyers at any stage get into homeownership is positive.
On something.
It might not help everybody.
Yeah.
Right? And buying in cities is expensive.
Very.
And we need like the teachers and the doctors and the service people to stay in the communities where they work. Yeah.
So is it still possible to use your program with CMHC purchases?
No. Oh, wait. So our product would not be compatible with insured mortgages. Not so much it's incompatible, but it wouldn't be necessary because we have all of our properties, we get them to a 20% down payment.
Okay, so
mortgage
CMHC
insurance is just not.
It's a default insurance.
Yeah, exactly.
So where I see the opportunity for Ourboro is with the alternate lenders.
Yes, there are a large number of our lending partners are alternative lenders.
The reason I feel like, correct me if I'm wrong, you could be new to Canada. You may not have a 20% down payment. You may not have an established credit, or you may not have an income level, or you are self-employed. Mm-hmm. So you may have a great income not on the taxes, but you may have a great income with on bank accounts, on business account.
Yeah.
So you can still qualify. You can carry the mortgage payment, but you may not qualify with the CMHC, with the traditional way of qualifying, and you need to get an alternate lending. And if you want to go to alternate lenders, they will not work with someone less than 20% down.
So A lenders, you can get, there's different mortgage products, but you're right. Like I think alternative lenders are more flexible in
income qualifying.
In income qualifications. And that's the biggest differentiator. And we see that as well too, to your point exactly. Those who are self-employed, those who may not have the work history, like the vanilla employment contract, 5-year employment.
Exactly. And the CMHC will not able to do those deals because you don't have an income that they're looking history. For on a traditional
uninsured,
rate.
Yeah, maybe on the insured side for sure. I'm not as familiar with the exact CMHC products, because we don't do with insured mortgages, but on just non-insured, like buyers that do have 20% down, even in an A lender product, they expect their ratios are a bit more stringent and their income qualifications are a bit more stringent. So we see that. But that said, the down payment gap pain point is felt by people across the spectrum. You have people with like
great income.
Bankers, software engineers.
They have great income.
In our homeowners, great income. Yeah. Exactly. And strong income history. You just cannot save up fast enough.
Because the cost of living and the inflation, everything has gone up and it's going to take longer.
Exactly.
What does it take about 14? Like what's that?
28.
Average?
So right now, the National Bank publishes data every quarter. And, it's always pegged at, it takes a household You need an average household income of over $250,000 to afford an average non-condo home in Toronto, and it would take you about 28 years to save up to purchase a non-condo home in Toronto.
And that's why the generational wealth,
It's
that's why
bonkers.
you guys are the bridge to get through it. But these individuals have a great income and a great credit. And
you still need to be a good borrower.
no,
right?
they're good borrowers, but they don't have a capacity because they don't have resources until they find someone like you guys.
Yeah.
And can you kind of walk through what the process looks like if someone they want to know, okay, how do I get in touch with Ourboro and get qualified? So you want to kind of walk through what the process looks like to...
For sure. There's different ways. I mean, a lot of our buyers come through partners like you. So a lot of buyers are talking to their mortgage brokers or their realtors around usually they see a property, they're kind of house hunting, they see something they really like, and then they're trying to make I'm sure, right? They're trying to make the numbers work. And so we're so grateful for our referral partner community. Right now, Ourboro has over 2,200 realtors and mortgage brokers, part of our referral network, which you are a part of, where they understand our product and are able to present it as an option for a lot of buyers. So I would say for buyers out there, talk to your mortgage broker if you have questions about our product as well too. Vernon's a great example, but also for realtors as well. You can reach out to your trusted real estate professional. They'll be able to figure out how to get your application into Ourboro. But if you're not working with a realtor or a mortgage broker, buyers can apply directly to Ourboro as well too through our program, and we have all the ways to be able to support them through that. And that's just through our website, ourboro.com. And it's a very simple application process. It takes about 7 minutes, I think. Last time we did a speed test. And once we receive the application, so an application is required whether you're referred to us by a mortgage broker or they're applying on their own. But once we receive the application, they do a quick 15-minute screening call with a member of our team. And just to answer basic questions and make sure you fit our eligibility criteria. And then we pass, they get to the mortgage pre-approval stage. So whether they're sent back to their mortgage referral partner or sent to another one of our mortgage broker partners, Ourboro needs a mortgage pre-qualification. We need to see from a licensed broker how much you qualify for mortgage. So then we know...
Based on your income.
Based on your income. So we know how much investment we need to set aside for you if we're going to work together. And then once we have that ready, then they're ready to be onboarded. So for Ourboro to do a deal, I just want to emphasize this point. For Ourboro to work with a homeowner, they need to be fully onboarded to our program. It's either a 45-minute one-on-one like Zoom session, or we're actually going to be introducing an e-learning, or they'll be able to do it online as well too. It's very soon.
So then what happens? You allocate the funds for the borrowers?
Yeah, so that's why once you're fully onboarded and fully qualified, then we set aside funds for these individuals.
And for how long?
90 days.
90 days.
So similar to a mortgage pre-approval where the rates are kind of locked in for 90 days, ours is kind of this.
And what about if they don't find the home in 90 days?
Then we can either renew, we can easily renew their
so they need to be in
qualification
touch with you,
us.
kind of stay in touch with...
Yeah, it kind of goes side and side with the mortgage pre-approval, right? If you received a mortgage pre-qualification... It
happens. They come after 180 days or like a 6 months.
Exactly. You want to go back to your mortgage and just to double check if the rates have changed or if your income, financial situation have changed, kind of just get a revised estimate.
But here's a little bit different because you are allocating the funds as like a pre-approval. When the banks do the pre-approval, they actually allocate the funds on the bond yields. Right? So you guys allocating the funds.
Banks don't need to kind of allocate funds. And we more or less allocate. We just want to make sure that,
when they come back, they don't have an issue.
Yeah.
Nice. Then the down payment will be given to the lawyer, or down payment will be given to the...
It's all done in the conveyance process. When the property is closed, it's almost like if you're purchasing at a grocery store, both Ourboro and the homeowner are walking up to the checkout at the same time, each with our contribution.
Okay, no problem.
Yeah.
And you want to talk about the revenue share model, like how it works?
The revenue share. Oh, when the home is sold.
When the home sells, yeah.
Yeah.
So that's the biggest question for a lot of people, like how much money Ourboro take from us.
Of course. And that's the absolutely important thing for people to understand. Like, it's our down payment contribution. It's not a loan, but it's also not free.
Yeah.
Right? They are sharing the upside. And the more the property appreciates in value, the more of those earnings they're sharing with Ourboro.
Both are gaining.
Yes, both are gaining.
It's a win-win for both parties.
Exactly. At the same rate, right?
Yeah.
And it all depends on how much we each put in. The absolute dollar amount that we get out will differ, but the rate of return will be the same for us and the homeowner. So I'll say, first of all, homeowners can sell at any time. If they want to leave the property and they want to move or whatever, they're free to sell. There's no minimum hold period.
Okay.
There's no expectation that the home has to sell for profit if markets are down. And we've had that happen. Homeowners buy and 6 months later, they need to be relocated for work. And that property really hasn't increased too much.
But the cost of selling.
But we fully support that sale process. Our co-ownership agreement is for 30 years, but anytime during that 30 years, they can sell or they can offer to buy out our share. So those are the two ways that they exit, is they either sell or they buy Ourboro out. For Ourboro, it doesn't matter because it's always done at fair market value, right?
So let's say I buy a property for $1 million.
Yeah.
In 3 years down the road, property has appreciated.
Yeah.
Let's say it's worth 1.3 million.
Yeah.
So I don't want to do anything with Ourboro.
Yeah.
I want to be on my own. So
you want to be on your own.
Yeah.
So there's $300,000 of appreciation in that property. The calculation for a buyout is the same as it is for Ourboro, with a slight nuance, which I'll talk to you about in a second. But just from the math perspective, we would have put in $200,000. So it was $1 million property, 20% down payment on day one would have been $200,000, right? So $200,000 plus.
So let's say I put only 50,000.
Yeah. Don't 50,000. Yeah, sure. No
out
problem.
of 200,000.
But basically, there's 200 of down payment, and then there's 300,000 of appreciation.
Good.
So there's $500,000 of profit. If you put in a quarter of the down payment amount, so if you put in 50% is 25% of the total down payment on day one, 25% of 200,000, you would get a quarter of that 500,000 of appreciation.
Correct.
Right, of the total equity, I should say.
Correct.
So then, what would that be? 1.25.
1.25.
Yeah. So when the home is sold, it doesn't matter what you get because you're buying us out, but more importantly, what you would need to pay Ourboro is the 3.75. Right? So you would need to be able to either have additional savings or unlock additional equity in your property to be able to finance that buyout. So for Ourboro, we get $375. So it's our $150,000 of the original down payment contribution plus our 75% of the profit. We get
75% of the commitment
of the
initial down payment.
75% of the profit.
Profit.
Yeah. So our original down payment was $150.
Correct.
And then we get 75% of the $300,000 profit. Yeah, exactly. But yeah, it's basically there's the original down payment amount and then there's the profit. So we get our original down payment amount back and then we get our 75 or 50% share of the profit.
So it's kind of tricky for them to buy out unless they save the 150 on their own to pay it out, right? So that's where I'm leaning into the next question. So you cannot pay from the equity. You have to have a savings.
You may be able to borrow in that. So if your home appreciated to 1.3 million, and assuming your income has also increased, because on day one, you would have had an $800,000 mortgage, right?
Correct.
80% LTV. If your home has increased to 1.3 million, you'll be able to take out, there'll be some equity for you to take out. You have to add to your debt load.
So not a lot though. So they technically come up with the original 150 on their own savings, but that's at least about 100,000 on their own savings.
Yeah, they would still probably have to contribute.
Because even if they refinance, they still need to come up with the savings. Yeah. So the best way to buy out is you need to have a savings plan in place.
And sometimes people can anticipate, they may be getting an inheritance or a divorce settlement or some sort of capital. We don't encourage people to use Ourboro as short-term financing in a way because it can be expensive to buy us out if the property has appreciated significantly. Our product is really meant for people who are looking for their starter home, not their forever home. So, we look at land registry data. I think 97% of first-time home buyers will sell by year 8. Yeah. Just sell naturally, life changes. And that's kind of our happy path.
So like 8 years is
8 years, they've lived in the home, property is appreciated at that average, 7% return or whatever it is. And then they're ready to move on and we move on together. And the homeowner takes that equity from their home and uses it to buy their next property, but hopefully without Ourboro. That's the way the model is meant to work. But we do have homeowners, and you must have clients who ask about, too, if they do decide they want to stay in the home, then they work with their mortgage specialist or they look at their finances to see if there's a way to buy out Ourboro.
So the main stigma I'm trying to come out is because everyone thinks, okay, I can get into the property, I can refinance. You cannot technically refinance and pay it out.
You do the math,
do the math. You need to come with the savings. You need as inheritance or some kind of savings you need to have in place to be an individual owner of the property.
Yeah. Yeah, exactly. I mean, if you only qualify for an $800,000 mortgage on day one, your income would have to increase significantly for you to be allowed to carry like an extra $300,000 of debt or so. Yeah.
There's no monthly payments. I'm sure that's other question I always get. Is any monthly payment on the loans? There's absolutely no monthly
Not
payment.
to Ourboro, no. But you, as a homeowner, there's payments. You got to pay property taxes.
But not for the down payment portion.
Exactly. Our contribution is strictly equity. There is no repayment to Ourboro. It's very important. Yeah.
And Ourboro is working with some major lenders, major banks as well.
Yeah.
So if they want to do the same process, they go to the banks and the banks apply on your own, or you have to go and tell the bank.
So our alternative lenders, so currently Ourboro works with Equitable, Community Trust, and Home Trust.
Home Trust, that's good.
Yeah, so all three of these alternative lenders only work through mortgage broker channels. So you need a mortgage broker to access those products. We do have a lender partner for a specific pilot program for homeowners that have 50% of the down payment.
Yeah.
And so for those home buyers, they can access that product directly through Ourboro.
Perfect. So the other important thing is purchase plus improvement or improvements to the home. So every homeowner wants to do improvement. They, like you said, average lifespan with the Ourboro is 8 years.
Yeah.
So you need the washroom to be done, kitchen
or
to be
even
done.
just moving in. You want to make it your own. Yeah.
So the property would have worth $1 million.
Yeah.
So let's say renovations done or construction done, and that brings the value up.
Yeah.
So who get the share of that?
Yeah, for sure. Great question. So we take a lot of pride in our co-ownership agreement and how we structure it so that the interests of our homeowners are aligned with our investors.
Correct.
And it's most noticeable in our renovation policy. So we want to incentivize homeowners to make those improvements, because if they improve the property, the value goes up, and that's win-win for everybody. But we recognize that Ourboro, we can't contribute, or we don't contribute financially to the renovation. What we do instead is we say, if the renovation you've done will increase the value of the home, you will get a credit when you sell the home that allows you a larger share of the profits.
Got it. And how do you verify that?
So the way it's calculated is it's the lower of what the renovation costs or the amount that it increased the value by. So and that needs to kind of protect us in a bit, because you could have a homeowner who does like an $150,000 kitchen renovation with like Italian marble and like tiles.
But you may not see value on that.
Yes, exactly, right. But we know that the maximum value of a kitchen renovation is maybe $25,000 to $50,000 for the home. So then in that example, the amount of the renovation credit will be $50,000. It would be the value that's added to the home.
So the borrower need to come and get the consent from Ourboro before they do the renovations?
So, and it's in their best interest too. So in the homeowner obligations, anytime they're doing, we call it a major improvement to the home that is expected to cost more than $10,000 or requires a permit, then they need to inform Ourboro. Ourboro needs to just look at it and make sure you're not like turning a 3-bedroom home into a 1-bedroom bachelor
penthouse.
Yeah, exactly. So we do need some sort of oversight in that. But it's also in their best interest to let us know of these major improvements, because then at the same time,
you get credit back.
Exactly. We can tell them, you know what, you're entitled, this qualifies you for a credit of this value, which will be applied when the home is sold.
And how the process works? You send an appraisal?
Yeah, so that's done internally through an appraisal process. We'll look at, and there's a lot of industry data around like what certain types of renovations.
So you kind of know what's the average to do a kitchen washroom.
Yes, exactly.
Anything you think I missed you want to outline about Ourboro?
I know we always, because our product is new, there's endless like skepticism. People are always and I think that's, with novelty comes skepticism. We expect it. Okay. And we speak
it's too good to be true.
So people get that a lot. And we say, you know what? It's not too good to be true. First of all, if you can afford to buy on your own, if you have the bank of mom and dad, or you have $200,000, do it on your own, right? You will be better off doing it on your own. But Ourboro's model is for those who don't have that option, where it's either renting indefinitely or using Ourboro. So or
stuck somewhere where you can change your lifestyle.
What is that they say? Like 50% of something is better than 100% of nothing.
Yeah,
exactly.
Absolutely.
One of the biggest misconceptions is that people compare us to owning on your own. And for sure, you are giving up a lot of equity.
You cannot even compare that way because you cannot even own on your own.
Exactly. If you're comparing as owner on, then yes, of course, Ourboro, you're giving up. It's expensive. You're giving up a lot of equity down the road. When you sell the home, down the road and you see kind of your trust ledger, there's going to be a large amount that's going to Ourboro, and you're going to be like, but you can't compare against.
You never had it anyways.
You never had it anyway. That's the way to look at it. Exactly. Yeah. So we've done the math, and shared equity with Ourboro is still like 10 times out of 10, still better than renting over like absolutely. A 10-year period.
And you're flushing the money away. And I want to highlight it's only for principal residents, not for investments.
You got it. Yeah, we're not yet. I mean, I love that we led with sort of the why of Ourboro, because we're at the moment, we're still very committed to helping homeowners get into homes. There are so many economic, social, health benefits to being a homeowner, and more people are being locked out of those benefits. And so we're just trying to create a bridge to get people.
Breaking the barriers.
Exactly.
And is it only in Ontario? You guys are lending?
At the moment, we are in the GTA. We're in Ottawa, Kitchener-Waterloo, Guelph, Hamilton, and then we're as far west as London.
Okay, so mostly Ontario.
Like 80% of the population of Canada, I think, lives along this corridor.
Nothing in Vancouver yet.
Maybe soon, but we will be looking to expand to other provinces in the coming years.
Perfect. Thank you for having me, and thank you for being a host.
Yeah, thank you for this conversation and for coming into our offices.
Okay, thank you.